Hello and welcome to Yadnya Investment Academy. Today we are going to talk about non-convertible debentures, also called as NCDs. We will start with what are NCDs and then discuss type of NCDs taxation, how to buy NCDs, and some advantage and disadvantage of investing in NCDs. So let's start with what are NCDs. Non-convertible debentures are fixed income instruments where you are promised a certain interest for a fixed tenure. Companies issue NCDs when they want to raise money for various needs such as expansion of their plant or new plant setup, etc. The NCD is a promise that the company will pay back the money at a promised interest rate as mentioned in the document. It is a closed-ended debt instrument, which means it is available for subscription only for a particular time period. In 2018, there was a surge in the number of NCDs from financial companies for retail investors, and it is expected to keep the momentum in 2019 as well. 11 to 12% fixed returns to investors is a very tempting offer to resist when equities are not doing so well. Not many fixed income instruments are able to deliver such high returns. The main attraction of NCDs has always been high returns to investors in comparison to fixed income instruments like bank deposits or RDs or post office schemes, etc. Let's understand in detail what are NCDs. Before that, we should understand what are debentures. Now, debentures are nothing but you are lending the money to the company which has issued the debenture. In return, the company is promising you the interest rate and return of principal at a specified time period. So then what is the difference between debenture and bond? In case of India, the difference between bonds and debenture is not much. Usually bonds are meant for long-term companies borrowing. However, debentures are meant for meeting relatively short-term companies borrowing. Debentures are part of bond market and are listed on exchange for secondary buying and selling. So you can check our video on how bond markets work to understand their working better. Now debentures are of two types: convertible and non-convertible debentures. Convertible debentures means after a specified time period which is mentioned in the document, these debentures are converted into shares of the company. And up to that time period, up to that conversion, you will enjoy a fixed specified interest rate on such debentures. After that, your earnings depends on price appreciation of the stock or the dividend income you receive like a shares, normal shares. What are non-convertible debentures, which are basically NCDs and topic of our discussion in the video, is they will never be converted into shares of the company. Investors who invest in such non-convertible debentures will enjoy fixed interest rate up to the maturity of such instruments, and after that the return of principal exactly like bank FDs. Now let's understand the type of NCDs. Secured NCDs and unsecured NCDs are two types of NCDs. Secured debentures or NCDs means companies, while borrowing money from you, usually along with promise to repay the interest and principal timely, put up some asset as collateral or surety for the loan. Secured means in case of company goes bankrupt or goes something wrong, the company will sell such asset and repay you the money which they have borrowed from you. Hence, secured debentures are usually much safer than the unsecured debentures. And in case of unsecured debentures, if the company goes bankrupt, then you will get money only when secured debtors who have bought the secured securities amount is paid back first. And hence, unsecured debentures are riskier than secured debentures, and also because of such risk, they mostly offer a higher interest rate to you than the secured ones. There is also a call and put option in NCDs, which we will discuss here. A call option means the company which has issued the NCD or debenture has an option to ask the investor to surrender the debenture after a certain period before the maturity date of NCD. Now, in such a situation, company will pay back the principal to the investor beforehand. Usually the companies exercise this option if the interest rates have gone down or company has enough money to pay back. Then there is a put option as well, which is for the investor, in which the investor has an option to surrender the debenture if he or she wants to before the maturity date and get back his or her principal. So suppose if interest rates go up and what you are receiving from your debenture is lesser interest than currently prevalent, then you can exercise this option and get back your money to invest somewhere else. Do remember that such call and put options are available to investors after holding the NCD for certain periods only, and you have to check in that offer document beforehand only if these options are available to you or not. Not all NCDs provide these options. Let's understand how are NCDs taxed. First, let's understand the how taxation of interest income of NCDs work. NCDs interest is taxed same way as bank fixed deposits interest are taxed. Interest income on NCDs will be taxable as and when interest is accrued and due. Entire interest income is treated as income from other sources and taxed according to your tax slab. If there is a short-term capital gain in NCDs, and basically if you have hold the NCDs for less than a year and sold it in the secondary market as NCDs are listed on exchange, then any such gain from this selling will be taxed according to your tax slab as well. But if you hold the NCD for more than 1 year and then sell them in the secondary market and you earn the gain, then such gain will be termed as long-term capital gain and charged at 10% tax without indexation benefit. Now, NCD taxation and much more is explained in detail with many examples in our knowledge book www.taxyadnya.in. Do check that out. Now, let's understand how to buy NCDs. During public issue of these NCDs, you can invest in them by submitting a physical form furnishing the details as requested, or you can make an investment online through your demat account, which is much more easier. Public issue mostly is open for specific period of time during which you need to apply for these NCDs. You can also buy NCDs in the secondary market as all the NCDs are listed on NSE or BSE or both. You can invest in these bonds through your trading account like the way you invest in shares. NRIs can invest in NCDs as well, provided the company issuing NCDs allows them to invest in it. Here are few public offers of NCDs which are open currently. Now let's understand what are the advantages and disadvantages of investing in NCDs, and we will also talk about what are the things you should take care in mind while investing in NCDs. Many of us blindly invest with the lure of high returns from such debentures, so we should not do that. Let's first discuss advantages. Now these are good investments if you are looking for a constant stream of income. Do remember that few NCDs offer you return interest and principal at maturity only. Hence, in such situation, they act like typical bank fixed deposits. NCDs offer higher interest rate than bank FDs. Definitely a biggest advantage. These NCDs are listed on stock exchange. Hence, in case of liquidity problem, you can sell it in the secondary market, but there is a big liquidity issues. We will talk about that in disadvantages. Interest will be directly credited to your bank account, hence the ease of managing money is there. There will not be any TDS for these NCDs if you held them in demat format. Hence, in this feature, they have an edge over bank FDs. And obviously, NCDs give a diversification to your debt portfolio as well. Now let's understand some of the disadvantages, and with the disadvantages we will also talk about the things to take care while investing in NCDs. First is credit rating. Credit rating of a security indicates the likelihood of the underlying issuing company of the NCD defaulting on its interest and principal payment. A rating of AAA, for example, indicates the highest quality or that the probability of default is extremely low. Next level is AA and then level forwards. Now here comes the disadvantage is that in a developing economy like India, where many companies are still establishing their earnings, ratings can sometimes shift lower quickly, leaving investors no time to respond if they hold a security which has been downgraded, and then there will be a liquidity problem as well at that time. For example, in recent case of IL&FS, it was a AAA rated securities, but in a matter of weeks or days, it was downgraded by rating agencies to very low ratings, and investors lost money at that time. So for these reasons, advisors recommend picking debentures from well established, cash flow rich and high rated companies only. But then obviously the interest rate from such companies will not be very attractive, so it's a trade off. Second is liquidity. Even though NCDs are listed in the secondary market like on exchange of BSE or NSE, they are very thinly traded. Hence, you may face a lot of liquidity issue when you want to sell these NCDs. So it may not be easy as selling a stocks, because there are high volume and high liquidity of such stocks. Then third is post-tax returns. Always check for post-tax returns on the interest you will receive. Formula to calculate the same is given here. Hence a 9% NCD may not give the same for 5%, 20% and 30% tax slab individuals. So you need to understand that. You need to always remember why a company needs the money. Check why they need money, why they are offering you such higher interest rate than bank FDs. If it is not possible to understand that, then you always check with your investment advisor. High returns mostly means high risk in terms of NCDs. So if they are offering you highest returns or much higher return like 11%, 12%, which is much higher than what bank FDs are giving, then there is always a risk involved. So mere secured debentures means not fully secure that you will get the money the next day after the company goes bankrupt. It doesn't work like that. Always check financial statements before investing. Financial statements like how much of their total assets have gone for unsecured loans, what is their capital adequacy ratio, what is their debt to equity ratio, and what are their NPAs and interest coverage ratio. So there are a lot of these kind of ratios and parameters which you should check mostly yourself, or always take help of your financial advisor in such cases. So that is all we have on this topic. If you have any question on NCDs or other debentures, then please write in the comment section below. And before we close, we want to tell you about our income tax knowledge bank called Tax Yadnya, which is a one-stop shop for your all income tax queries. Every income tax query which you have will be solved there, and it is always updated. It is available on the mobile app as well as web. You can check our website taxyadnya.in for more details. Hope you have a great time ahead. Jai Hind.